Hi, everybody. My name is Josh Spisman. I'm an associate professor of finance here at Loyola Marymount University in Los Angeles. And we're doing our weekly video with my colleague, Professor David Offenberg. And David, I know you're an absolute expert on entertainment finance. And this week I saw the stock of Netflix just went crazy. And I was hoping you could explain to me and all of us a little bit about what you think is going on.
I know. Look at this graph. Look at this graph. What CEO would not be excited for this right here? That is their earnings announcement. And what happened in their earnings announcement is they beat expectations on how many subscribers they added. This is the real story of Netflix, is that they're adding subscribers more faster than anybody ever expected. This charts from Entertainment Media Capital. They're showing how many subscribers Netflix added each year from 2012 all the way out to 2020. And look at this. Look at this 2020 bar. It's outstanding. They added over 36 million subscribers in 2020. But why this is so exciting is because of the blue piece right here. This blue piece is the international editions, and it's 85% of Netflix's subscriber additions, meaning that they're still growing like bonkers all around the world. Not so much in the United States. The US growth has really shrunk and matured, but there are now over 203 million subscribers. And we think there are about 1.5 billion subscriber households in the world. So they still have a lot to go. So this is a stock that's still growing like crazy. So people are excited about it.
Yeah, wow.
They're
Oh, sorry, I didn't. I mean, when I guess when we're all stuck at home, it's good. We need something to do, right? So,
right. And so that's it. The subscriber count is part of it, but there's a second piece which is more enduring, which you can see here. What these red bars show, so the red bars are the profit, and you can see the profit going back to 2018 was about $1 billion, and then it grew to about $2 billion, and then in 2020 it was nearly $3 billion. They're getting really, really profitable. But the funny thing is this blue bar. The blue bar is how much debt they're adding. And look at this. In 2018, they added over $4 billion in debt. And then in 2019, they took on another $4.5 billion of debt. But in 2020, it was only $1 billion. It shrank and it shrank, and people are getting excited about that because of the yellow bar. The yellow bar, the free cash flow, it's finally positive. And free cash flow has been negative for years. It was even though Netflix was profitable, the free cash flow was negative. But suddenly, this free cash flow has turned positive, and that's exciting for Netflix investors.
so David, why, if they're profitable, how come they were having this negative free cash flow?
Right. And so this is one of the funny things about accounting and finance. Profit is a fictitious number, right? It doesn't exist in the real world. It's based on a whole bunch of rules that are separate from the actual cash flowing in and out of the business. The free cash flow doesn't incorporate non-cash expenses, whereas the profit does. The profit has non-cash expenses. Josh, can I give you an example of a non-cash expense?
Please, yes.
You tell your daughter, if you clean up your room, I'll take you to the park. She cleans her room, you take her to the park. That trip to the park, that's a non-cash expense. It doesn't cost you dollars, but it costs you. I mean, it's
It,
fun. Don't get me wrong.
it's fun, but that is a great example.
And companies do the same thing. Companies pay their employees in stock, and stock is not cash.
Mhm.
It is a made up thing. Companies can make up as much as they want, and they can pay their employees in cash. It shows up on the income statement as an expense, but it is not cash leaving the firm. With Netflix, stock based compensation is not the big problem. The big
Mm.
problem is amortization. Amortization means that they spend a whole bunch of cash to make the show, but the IRS and the SEC say you don't actually get to show that expense here where you spent the cash. You're going to show some in the first year and a little bit less in the second year and a little bit less in the third year and a little bit less in the fourth year. And so these small expenses are what is making that profit look big. When Netflix has a profit against negative free cash flow, it's because they're not recognizing the whole cost of all these shows that they're creating. The whole cost of shows is here in the free cash flow. That's where the cash is coming out. So
That's
that's
great.
why Netflix is profitable, but burning cash historically. They finally turned the corner, and they're finally probably going to start using a whole lot less debt. But here's the question I have for you, Josh.
Yeah.
Why is this debt bar, this blue debt bar, why is it so big compared to the free cash flow bar? Why are they borrowing so much more than they need?
Yeah, that's a good question too. I was thinking about this. There's so much, they're taking on so much debt, and they're not the only company doing this. Um, but part of this can really be explained by just looking at the cost of borrowing right now, and we're seeing this very, just historically low cost of borrowing for companies such as Netflix, and this is Netflix's after-tax cost of debt going back to 2012, and you could see their borrowing range is in basically between 2% and 4.5%. So they would be crazy not to be borrowing the way they were at rates that low. And I think Netflix has done a great job actually. If you think about it, of growing their stock price by really investing using debt to invest in the company.
And if you look at the scale of this debt, it's really small compared to the size of the company. Netflix is a huge company, and they've only taken on a few $billions of debt. So they're really not in any sort of trouble with this debt, right?
And you can actually see that here. And you could comparing them to some other companies in the industry, but their debt to their market capitalization is very low. So their debt to market capitalization it's about it's 0.06. That's tiny. This is a very tiny amount when you look at their total market cap.
Right. And so it made sense. It made a lot of sense that we saw this pop in the stock this week. There's a lot for investors to be excited about with Netflix, and we'll be interested to watch them grow in the years to come.
Great. Thanks. Well, that explains it. It's going to be a great weekend now that I know.